Hey guys, my name is David Kinsman. I'm here with Missouri Farm Bureau, one of your local Farm Bureau agents here in Springfield. I want to take a minute and kind of explain the difference between borrowing your life insurance policy and owning it, and kind of the comparison to almost how we can relate it back to owning and renting a home. So I kind of made this illustration here to kind of explain some of the differences for us. So the first one I want to kind of go over is that renting. And a lot of this is going to be our term policies. And so our term policies usually can be super cheap, probably get one for $20 a month. And a lot of it's can be very common to like running a home. Whether you have it through work or you have it through an independent agent like myself, and it's a term, you're renting it. You have it for X amount of years, whether it's 10, 20, 30 years, same through work. As long as you work at that company, you have it. But once your years are up or you leave work, it's gone. So is all your premium, all your coverage, everything else. Very similar to like renting a home and paying all your rent money to that landlord and then moving out. There's no money left for you. The other side of it would be like owning your home, going to a bank, getting a mortgage, financing your home. So we think a lot of like a whole life policy. And our whole life policies, we kind of say might run $50 a month. So we know it's a little bit more than the term, but you got to own the product. You own your policy. You can't outlive it. So the great thing, doesn't matter if you switch jobs, switch careers, years go by, you always have the coverage. It's always there. Only downside is coverage lasts forever, so does the payment. So you're paying on it for a long time. So the benefit of it is when we're in our later years of life, you're 70, 80, 90 years old, where you're no longer eligible to purchase it, you already got it. It's already taken care of. Now the other side of this is what we call our pays. And so whether you do a pay 10, 20, 30, it's the benefit of the whole life, but we can shrink your payments down. It'd be like getting a mortgage, but only doing a 10 or 15 year note on it. You get it paid off. So this might be $100 a month. So a little bit more, but we can see we can limit our payments, have it paid off quicker, and then we got it forever. So same concept with like owning a home. You build equity, you build value, you can borrow your equity if needed, you can sell your home and make a profit. Kind of same concepts in your whole life policies. They're going to build dividends and cash values for you that you can use and help increase the values of your life policy as you get older. So same thing, the benefit of this one's when you're in your 60s, 70s, 80s, 90s, you're no longer paying for it. It's paid off, it's done, and it's going to be there for you when you eventually need to use it. Where these other ones may run out, you don't have any, this one you've been paying on for a lot longer. So kind of a good idea of kind of how it breaks down to coverage, how we can take our whole life, our life insurance product, whether you got it at home, you got it through your insurance agent, wherever you're getting it, kind of a good idea to kind of break it down and explain it. You're either renting your life policy or you're owning it.